guys, welcome to Talking Money with Nozi, personal finance made simple. In this video, I'm going to be talking about whether you should pay off your debt first before you start investing. Before you even think about investing or paying off debt, you must set up an emergency fund which is worth 3 to 6 months of your expenses. If your expenses are 10,000 Rand a month, for example, then your emergency fund should be between 30,000 to 60,000 Rand. An emergency fund is money that you save in the bank to use in cases of emergency. Emergencies are things like losing your job, getting sick or injured, death in the family, getting involved in an accident. All of these things need money. If you don't have any money saved, you are going to be forced to get into more debt to pay for the emergency. I've heard people saying that they would rather pay off their debts first and then save for emergencies afterwards. That strategy would work perfectly if you could predict when emergencies happen. But unfortunately, emergencies cannot be planned, right? That's why they're emergencies. They happen at any time and they definitely will not wait for you to pay off your debts first. It may seem like a waste of time to save when you have a lot of debt, but having an emergency fund is one of the best ways of protecting yourself from digging yourself further and further into debt. But what about investing? The difference between debt and investing is that investing is when you use cash to buy assets like shares, ETFs, unit trusts, or real estate that will grow in value over time and give you income. But debt represents money that you've spent already and you need to pay back the full amount that you borrowed plus interest. If you don't pay your debt, that debt just grows bigger and bigger with interest charges adding to your balance, and that interest attracts even more interest charges. Basically, unpaid debt takes money out of your pocket while investments put money into your pocket. Investing and paying off debt are both important financial decisions. So, should you wait to pay off debt before investing, or should you do both at the same time? Well, the answer to this question depends on your situation. Sometimes it is necessary to pay off debt before you invest, and other times you can invest and pay off debt at the same time. So how do you decide what to do? Well, you need to look at the numbers first. Check the interest that you're being charged for your debt versus the rate of return on your investments. As an example of what a credit card can charge you, I just went to the Nedbank website. Let's scroll down right to the bottom to see the interest rates that are charged on Nedbank credit cards. Okay, here we go. The new Nedbank Gold credit card charges an interest rate of 20.25%, and then the Nedbank Platinum credit card charges interest rates from 18.4% to 20.25%. These are annual charges. And then for personal loans, again, I just searched on the internet, came across this Sanlam personal loans. Let's scroll right to the bottom to see what they charge. So here we go, 15% right up to 27.25%. These are annual interest rates. You then compare the interest charges on your debt to the rate of return on your investments. Next, what you want to do is your rate of return of your investment. I like using the S&P 500 because it's one of the ETFs that I invest in. I just want to see how this ETF has performed in the past. Of course, past performance doesn't guarantee future performance, but it's the only thing we've got. Nobody knows the future. We use the past to kind of estimate what's going to happen going forward. So you just go to Google, type in S&P 500 average returns. I like Investopedia. This is an excellent website if you're a beginner, if you want to learn the language of investing, look up statistics, go to Investopedia. It's got a lot of resources. Let's click there. And what does it say? Let me just zoom in so that you can see this. It says that the average annualized return since its inception in 1928 through December 2021 is 11.82%. Then it says the average annualized return since adopting 500 stocks into the index in 1957 right through to December 2021 is 11.88%. So essentially, the performance of the S&P 500 since its inception is about 11.88% annually. So now you get it. You compare your rate of return to how much your debt is charging you in terms of interest. So if you're investing when you have high interest credit card debt or personal loans, you are paying a higher interest rate on your debt than you are earning via your investments. This means you are losing money overall. I always compare investing when you've got high interest loans with trying to put out a fire using a teaspoon of water, because your debts are growing at a much faster pace than your investments. Essentially, you're working backwards. The next question is how to pay off your high interest debt. If you have enough money to pay off everything, then just pay it off. But if you don't have the money to pay off all your high interest debt at the same time, then you need to prioritize. Generally, you will save more money if you start by paying off your debt with the highest interest rate first and working your way down to the lower interest rate. For example, if you have one debt that's charging you 20% and another that's charging you 15%, get rid of the 20% balance first, then the 15% balance afterwards. Or you can use the snowball method, where you pay off your debts from smallest to largest. Whichever method you choose, make sure that you pay off your debt as fast as possible so that you can free up your income and start investing as quickly as possible. Remember, investing needs a very long time, and the sooner you can get started, the better. If you are really deep in debt and you're struggling to keep up with payments, contact your creditors and ask if they are willing to reduce your installments or reduce the interest rate on your debt. The worst that can happen is that they say no. And if they say no, you're not going to die. And you'll be surprised. Creditors want their money, right? So they're going to try to make it easy for you to pay them. And if that means lowering your interest rate, they're going to do it. If it means lowering your installment, they're going to do it. So don't be afraid. Pick up the phone or send them an email and just tell them that, look, I'm really struggling. Can you bring down my installment or my interest rate? And most likely they'll say yes. Another option, if you're really struggling, is getting a registered debt relief company to handle negotiations for you. But please be careful, because this is an area with a lot of scams. So make sure that whoever you're dealing with is actually registered with the National Credit Regulator, the NCR. Sometimes it is not always necessary to wait until you pay off all your debt to start investing. Remember that some debts are worse than others. So for example, a personal loan is much worse than a home loan, because in most cases the interest rate on a personal loan can be double that of a home loan. Also, a home loan is a long-term debt, and it would not make any sense to wait until you've paid off your home loan to start investing, because you would lose out on a lot of time in the market. Remember, the most important thing about investing is time in the market. The longer you can invest, the better. Okay guys, that's it for today's video. If you have any comments or questions, please type them in the comment section below and I will get back to you. Also, please remember, like this video and subscribe to my channel. Thanks for watching guys. I will see you in the next video. Bye.